Nilesh Shah of Kotak AMC. Uh, let's take the conversation forward with you, Nilesh bhai. And the conversation is, how should one look at this fall? Is it a change in the India story? Is it temporary? Or this is just a much needed fall and we may use Fed or geopolitics or crude just as an excuse?
So I completely agree with all things which Prashant Bhai mentioned. I was listening to him carefully. I don't think so. This is a pause or a U-turn on India growth story. If at all, it is actually acceleration for India growth story over a long period of time. Long back, there was BRICS, Brazil, Russia, India, China, South Africa. Today, Russia, Brazil, South Africa are way behind India, and China is also behind India. With these events, India gets even higher attention in global investors' radar. Second, markets are markets, they'll go up and down. Yesterday, they were down on FII selling. Today, they are up because global markets have recovered. So in the near term, news on war will continue to impact our market. But we believe our fundamental story is intact. Of course, it does get adversely impacted by higher energy prices. We import about 4 million barrels of 4 million barrels of oil a day. $10 price increase is $40 million outflow from your pocket, my pocket, government's pocket, or corporate pocket. But our long-term story remains intact. Elevated energy prices creates a dent which we can afford.
Just wanted to understand whether or not for SIP investors, does anything change with the ongoing events, and should anything change at all? Because they're in the market for the long haul, so they should not be giving into the panic.
Undoubtedly, and that's the experience of March, April, May, June 20. SIP investors today still have positive return on a 3-year, 5-year, 7-year, 10-year basis, and reasonably good double-digit positive return. But in March, April, May, June 20, 3 years returns were negative, 5 years return were lower than savings bank account return, and 10-year returns were down 50% to become comparable to bank fixed deposit return. People who did not do anything and continued their SIP today are enjoying the fruits of double-digit return. People who panicked and ended up stopping their SIP lost a great opportunity to make money. People who panicked and redeemed their SIPs converted their notional loss into actual loss. And the smartest one were those guys who topped up their SIP when SIP returns were negative. So my recommendation is that please follow the dharma of asset allocation. Continue your SIP. Yes, 3 months SIP returns might be negative, but you haven't come here for 3 months. You have come here for 5 years and 10 years. Please maintain dharma of your asset allocation.
Having said that, Nilesh, does one really need to tweak your portfolios? Do you, in times like these, maybe tweak your portfolio towards a higher allocation to large caps and safer assets in that sense?
Undoubtedly, you have to play the ball on its merit. You can't go predetermined that I will always play on front foot. So you have to tweak your portfolios. That's what active fund management is all about. But if you have invested with a fund manager, then he will do the tweaking. You focus on your asset allocation. Second, the tweaking happens on a medium to long-term basis. It can't happen on a daily basis. So if you are active fund manager, yes, process all the information. And if your fundamental view changes over a medium to long term, then do make the tweakings. If you are an active investor yourself, of course, you have to make tweakings, but don't try to tweak based on everyday price movement. You will be catching your tail kind of thing.
Morning. I just wanted to understand what the outlook would be when it comes to the banking sector, given its overall weightage and the way we've seen it perform, pretty much neck to neck with the frontline index. As Prashant Jain was just saying a short while ago, he believes that the re-rating in banks may be delayed. Would you concur?
So within banking and financial services, I believe there will be differentiator. There will be one set of banks where credit standards are reasonable, other set of banks where credit standards are not reasonable. Today, fortunately, there is a lot of convergence on the NPA cycle as the worst seems to be behind us. The second differentiator will come in terms of use of technology and owning customer. There are many banks which are using data analytics and employing technology to get connected to customer and owning the customer. There are many banks where customers are not owned or extracted appropriately in terms of products, in terms of relationships. The third differentiator will be the valuation. Now, as business model of most banks veer towards retail, towards large corporate loan, towards conservative credit, the valuation differential also will come into play. So we believe today in banking and financial services sector, there are few private sector banks and one or two public sector banks which needs to be invested from a longer term point of view. Also keep in mind that there is NPA recovery happening in many banks, and hence their quarterly numbers for at least FY23 will be way better and way ahead than last year.
Banks fit into that basket, or you continue to maintain that they are a bit of a trading play vis-a-vis a long-term investment bet?
We believe select banks are long-term investment bet. They are compounders. Some of the banks where you may see very large increase in profitability thanks to the NPA cycle reversal, one can probably take a trading bet. But please remember, trading is always injurious to an ordinary investor's health.
Thanks very much, Nilesh, for joining
Thank
in
you.
as always and sharing with us your market expertise. That's the view coming in from Nilesh Shah, talking about how, as of now, you need to be selective when it comes to the banking sector as of now, and elevated energy prices. That's the big concern. It's a dent where we can't afford. But for SIP investors, continue to maintain the dharma of asset allocation. A quick glance at the